system in Mexico, and now obviously he's in charge of Mexico's public credit. He has a PhD from Harvard and he has an engineering degree from MIT. So with that, I left you with Jose Antonio to talk about how Mexico manages oil price volatility. Thanks.
Thank you, Alejandro. It's always a pleasure, and it's always intimidating to share the floor with you. Alejandro, you know, Alejandro and I worked together for a very long time at the Treasury. The thing that I would like to talk about, that I've been asked to talk about regarding oil volatility, I would like to have a preface on that, because many times people think that if you cover the price of oil, that can solve all of your problems. And the truth is that it's only one element to absorb volatility in the markets. There is no substitute for having sound fiscal accounts, for having sound monetary policy, and for carrying out prudent macroeconomic policy and prudent financial policies. If you don't have those, then it doesn't make too much sense to go to the markets and cover prices and things like this, because it's not going to work. You really do have to do the homework on prudent financial and macroeconomic policies, and that cannot be overemphasized. It's not quite as elegant, perhaps not quite as sexy or as sophisticated, but the first thing to do in order to have stability when you face volatility in the financial markets is to have sound monetary, financial, and fiscal policies. Having said that, I will get into the hedging program that Mexico has been doing for quite a long time, actually, and what is the reasoning behind it, and why it works for us, and why I think it's a good idea and it's a good example for other things. Mexico has been doing the oil hedge program since 1991, and the reason I remember it was the Kuwait War, and at that time somebody advised the then Minister of Finance that the price of oil that the war was going to be very quick, and that the price of oil was going to fall very drastically. So that was the first year that Mexico decided to do a hedging program. Now what's interesting is that the Constitution limits Mexico's ability to hedge its oil production, but it doesn't talk about financial instruments. It says you can't sell the future production of oil, but it doesn't say that you can't buy puts in the markets. So Mexico has been buying puts in the markets since 1991, and the logic of the program is not to make money. I mean, we're not oil traders, even though at one point an illustrious member of the IMF here and the boss of Alejandro Anaya was called the best oil trader in the world and the worst paid, because he made a killing of several $1 billion in 1 year. You were the undersecretary at that time, so he probably has the number right. But it was a very important reimbursement that we got. But that's the way we look at it, as a reimbursement. We're not there to make money. We are there to ensure that in the course of the year we don't have to adjust our spending programs to the price volatility. So the way it works, I will try to simplify it, and it's been evolving over time. It used to be that it was done all internally at the Ministry of Finance. And the Ministry of Finance would see how high a price it could hedge for the following year, and that was the budget price that was the oil price for the oil budget in Mexico. Oil used to mean about 40% of public revenues in Mexico. Now it doesn't. Now it means about 18%, but it's still an important parameter for our federal budget. The way it works now is there's a preset formula. So you can that says what the price of oil should be for the budget the following year. It's a formula that looks at futures and it looks at past history. The formula moves, there's a bit of interpretation on it. So somewhere in the second half of the year, the Ministry of Finance starts buying these derivatives, so that by the time the budget is approved in November, we have hedged the entire position of the Mexican government. That way, if the price of oil falls below the budgeted price, the derivative pays, we're in the money, the derivative pays the outcome. So the objective is to get certainty. I insist, it's not to make money. The objective is to make sure that halfway through the year, you don't have to make expenditure cuts. Now, it's interesting because, as I said, the federal government has been doing this for a long time. When I got to Pemex didn't have a hedging program. And that didn't make too much sense to me, so I started asking around, why didn't Pemex have an oil hedging program? And the answer was interesting. Big oil companies do not typically hedge the price of oil. Airline companies do and users of oil do, but oil companies typically don't hedge the production price of oil. And there's a couple of reasons for that. One is that the costs of extracting oil are correlated with the price of oil. So if the price of oil falls, the costs fall, and your profits are not squeezed all the way through. And the second reason is, oil companies have capital, and that's what capital is for. Pemex is a public company, it doesn't have capital. So when I arrived in Pemex in February, the budgeted price for oil was $50 a barrel. And all predictions showed that it was going to be 25. So clearly we were over budgeted. And one of the first things I had to do, literally the first 3 days, was to start in a budget adjustment program that was huge. It was $5 billion, more or less. It was 20% of Pemex's budget. So I wasn't a very popular CEO. When you get in and the following week you announce a budget cut of 20% of your expenditures, you're not very popular. Since then, Pemex now has a hedging program. Very similar, almost exactly similar to the federal government's program. And we only hedge our net exposure to the price of oil, because we produce a lot of oil, we refine some of it, but we also import gasoline. So our net exposure is not our full production of oil. So that's why we don't have to hedge our entire production. What this means is that we have given complete certainty to the investment programs in Pemex. And that makes a huge difference, because you start the year and you tell people this is your investment program, and there's not going to be any cuts in the course of the year. And that's very important for cost reasons, and it's an analogous reason. It's an analogous argument for what the federal government is doing. The price of oil is the same at which we hedge. It's the price of oil that is approved by Congress, and that gives Pemex our budget and the rest of the federal government the budget. So that's kind of the way the program works. It has been complemented recently, in the last few years, with funds. Instead of buying coverage, now we have a special oil fund, so that it helps us cover whatever we can't cover in the markets. And we also have fiscal stabilization funds that helps us to move for other volatilities that are not the price of oil, like in
Mr. Minister, on the oil price volatility we're seeing, what is, as a former Pemex CEO and then Finance Minister, what's your prediction on where the oil prices will go?
I was told never to predict the price of oil because you make a mistake. So I never predict the price of oil.
But when you're doing the hedging futures, how do you do that?
We do it the way I explained it in the conference. We do it based on the needed budgeted price. It's not, we're not trying to outguess the market. We have a formula that determines the price of oil for the budget, and that's the price of oil we hedge.
So you hedge for that budget for the next year. How long in the future? 1 year, 2 years? So every year you budget. All right.
What is that?
That's Google Glass. So it's like the new technology. Yeah.